Hello, and wishing all our viewers a very happy Diwali. Welcome to this special segment on Moneycontrol where we take you through some key stock ideas across themes. My colleague Lavisha Darad had some very interesting conversations with market experts and analysts, and here are some important takeaways. Let's start with one of the key themes that she focused on, which is the EMS or Electronic Manufacturing Services sector. This is one of the fastest growing themes in India's manufacturing story. Leading names like Amber Enterprises and Keynes Technologies are expected to benefit as India's electronics ecosystem scales up. The EMS industry is currently pegged at around 3 lakh crore rupees, and this could nearly triple to about 8 lakh crore rupees by FY29. According to experts from PL Capital, the growth in this segment is likely to come from high-value areas such as industrial, automotive, medical, clean energy, and IT hardware manufacturing. So India's EMS sector will move from just beyond assembly to actual component manufacturing. Further, there are government schemes like the PLI or Production Link Incentive Scheme, which is further expected to boost this transformation. PL Capital is very particular optimistic about Amber Enterprises and Keynes Tech due to their very strong order books, backward integration, focus on higher margin segments. Amber is moving beyond just consumer electronics into manufacturing industrial electronics, while Keynes Tech 2 is looking very promising and promising profitable growth ahead.
Right, in this edition of Fireworks and Fallout Themes, we will be putting the spotlight on EMS sector. Now, this Samvat, the stocks from the EMS space have showcased a mixed performance, but the Indian electronics manufacturing story is entering its most decisive phase yet. So, from just assembling gadgets to actually building the brains inside them, EMS companies are climbing up the value chain, and brokerages, they are calling it the next multi-year growth engine. Now, backed by the government's push for component localization and rising global demand, the sector is fast transforming into the India's Make in India power play as well. But yes, sir, to discuss how the sector has fared this Samvat and what lies ahead, we have with us a special guest who will decode the length and breadth of the EMS space. Joining me is Praveen Sahai, research analyst of PL Capital. Praveen, good afternoon and wishing you the best of festivities and a very happy Diwali.
Yeah, hi, good afternoon, and wish you and your audience as well.
Praveen, let me start off with the first question. EMS stocks, they've showcased a mixed performance in Samvat 2081. While some of them have doubled their value, some have also declined in double digits. Take us through how the Samvat has been for EMS sector, what the outlook looks like for Samvat 2082.
Yeah, definitely. The last year they had performed. Some has performed very well. Some definitely has given a negative return. So I can say that those who are have a very strong order book, very strong growth, diversified throughout the different verticals, different segments. And also the diversification in the customer base and the clear roadmap towards the backward integration, they had definitely did very well. Like Amber, Sirma, Avalon kind of a player has given a 55 to 90% of a return. Keynes as well 20% plus of a return. Whereas some names like a Scient, APEC, or the PZ, they are in the negative because of the growth what we anticipated as a street, they had not matched that, and also there is some seasonal impact to that, so that is the reason. Secondly, on the the players, as I say, that's which have a weak order book or the weak visibility related to the margin improvement had not done well. Now from here onwards, I am quite a positive on the players who are diversifying largely to the customer base, to the sectors, as well as backward integrations. So those are expected to do well from here onwards as well. Definitely, you can say the valuation is one of the catch from here. That's I believe those who are continuously focused on the executions, focus on the return profile and the capital discipline. So they will able to deliver the earnings as well as the return stock returns you will see in the future.
Okay. Praveen, right now the EMS industries were estimated about 3 lakh crore rupees, but Street has been pointing out that it could reach by about 8 lakh rupees, 8 lakh crore rupees by FY29. So what in your view will be the biggest growth drivers that would take it from just an assembler to a true component manufacturer?
Very excellent question. But one thing is, we are largely assembler, whether it's a contract manufacturers or the EMS space, the PCBA. Now we are gradually moving. That is a very long process, I can say, towards a component manufacturing. Because in the PCBA, the PCB itself, bare PCB account around 15 to 25% of the cost. And now we started building some our ecosystems in that. Some big names like of a Sirma, Amber and Keynes already announced their big capex towards the PCB manufacturing. The other things in the entire component space is a compressor, plastic molds, or in the OSAT space, some display panels. These are the spaces where some activity is going on right now. We also need to create our vendor development. So these, EMS player also required a local supplier for such products. So those are the long fetch story I can say from here onwards by 2030. As you highlighted, that's a 8 lakh crore by 20 FY29. Then by that time the component ecosystem will also get developed, and from right now 90% import of a PCB, we will reach to around 30-40% of our local manufacturing of a PCB, and the other components like a motor or a compressor will also get developed. So definitely, as the opening remark you mentioned, that's this is in the long-term growth trajectory the EMS space is entering, and I am in the same view. These are also getting backed by the government, the PLI scheme or specs schemes. These are facilitating the ecosystem for a component manufacturing. So I'm quite a positive for the way forward for the EMS space and the component manufacturing as a main theme for that.
Okay, okay. But Praveen, they have always seen, quite margins have always remained in the low single digit for majority of the EMS players. Right now, they are majorly focusing on margin expansion, and they're driving, driven by shifting their attention to higher value segments like automotive, industrial, and clean energy. But do you think that this margin improvement is sustainable, or is it just a short-term mixed benefit?
So for the margin, we need to understand we started our EMS journey from the consumer segment, consumer durable space, contract manufacturing. And largely, like still, if I look at more than 60% is related to the mobile ecosystem we had created. There definitely the margin profile is a lower. When you go up from the consumer to the automobile to industrial to EV component to clean energy or a medical, your margin profile from a mid single digit go to the up to a 20%. So just to give you some more sense in that, like consumer give around 4 to 5% of a margin, whereas industrial fetch 15 to 20% of a margin here. Automobile from a 7% to around 9%. So when you go up in the value curve in the sector wise, your margin profile usually go up. One is that. Second thing is a backward integration. If you go for a PCB manufacturing or the plastic molding or sheet metal, these are the component for the contract manufacturers as well. So their backward integration also brings some margin levers. Third thing is the scale. Now we started with a very small scale in our EMS journey, and that's the last 4 years is the journey accelerated with the government support. When the scale up these facilities, that's also brings some operating leverage. So all three things I believe will brings the margin improvement. And like if you look at the Keynes who fetch around 15% of a margin right now at the consolidated level. So because they are more focused on the industrial and the automobile, and so as the other players are also like of a Sirma reducing their consumer segment contribution and improving the auto industrial IT services, businesses more, and the margin improving to the double digit. So what I can say, the way forward, we will see around 100, basis points of an increase from the historical average from here onwards in the next 3 years.
Okay, 150 basis points of increase. Praveen, India still imports about 90% of its PCBs, but companies have been investing to aggressively change that. So how realistic is the timeline for this meaningful import to substitution in majority of the core components?
Yes, rightly you highlighted that's a majority we import right now, and in that, as I said, that's the in the PCB around a 15 to 25% is the PCB manufacturing. PCB cost is the 60% cost is of a component like a IC or a capacitor resistors. Right now, we are developing, and we are as a government giving a lot of incentive programs to develop the ecosystem of a PCB manufacturing right now. The major players like Amber, Keynes, Sirma has already announced for their capex plan in the PCB manufacturing. One. Second thing, they had already also with these capex announced the JV with the technical tie-ups. Like a Sirma with Sehap JV they had created, Amber Korea Circuit JV they had created to bring the PCB manufacturing, and not just a single layer or double layer, but the multi-layer and the flex PCB manufacturing, which is a need of our, which are used in the EV as well as smart phones. So the commitment right now from the Keynes is nearly 14 billion rupees. Same Sirma has announced for 91 billion USD. Uh, Even the Amber with the two of their ventures in the PCB manufacturing, that is 35 billion in the Korea Circuit JV and 6.5 billion rupees in the SN Circuit. So that's overall three major players are putting up around 60 billion rupees in the couple of years to create the PCB manufacturing. And I believe that's the not only these three, there is some more players are coming in. And from this 90% of our import dependency on the component, by FY30, it will be from the 10% to a 30%, 30 to 40% India manufacturing of the component to reach.
Okay. Praveen, that's rightly you pointed out that, more companies are aggressively moving to PCB manufacturing, and we've seen a huge capex also being planned between FY25 and 28 itself. So do you think that these companies have the balance sheet strength to absorb that kind of an upfront investment, or could it pressure the returns in the near term?
Yeah, exactly. You are right. I don't see there is a big balance sheet of these players, and that's what we had seen in the past. And the last year, we had seen a lot of fundraising, QIP, when the debt raising happened related to the expansion. And in the next couple of years or 3, 4 years, we will continue to see such kind of activity in the EMS space. Because these ecosystem development is capital intensive. Return profile definitely will be muted once the scale will come in. Definitely we will see some kind of a improvement. And the most important here is for the development of a component ecosystem, government support is required. And that is why the government has given like of a 65% incentive in the OSET. Similarly, 65% of an incentive, which is a mix of state and the central government, towards the PCB manufacturing. So those supports, the government continuously need to come out, and if these players will utilize those, definitely the return profile would be at the level where they are operating at. But definitely this fund requirement thing is that definitely would be there. Balance it is not as big as to factor in this. So the government support as well as the equity or the debt raising activity we will continue to see in this sector.
Okay. So there's huge capex also lined up, and we'll be hoping that there's margins recovery that takes place in the upcoming quarters as well. But Praveen, if you look at several of the counters, they're already trading at about 50 to 60x of their FY27 earnings. So at what point do you think these growth expectations start to look over optimistic?
No, so the point is, this sector is in the nascent stage. Government, as I said, is a 65% of incentives. Some are upfront incentive, some are incentive-based incentives. So definitely, the government focus on, like example of a OSET where the 50% is upfront capex the government is doing. So that entails that the growth story in this sector to continue. And also the margin, as I said, when we go from the low segment to the higher segment of industrial or the medical or the IoT, our margin to improve. So in that, we have to give some optional value for the future growth prospects because this sector itself is in the nascent stage. Definitely in our numbers, if I look at 27 or 28, definitely the OSAT or the PCB manufacturing to the some players we had affected in, but the execution is a key. Like those who has already performed in the last couple of years, delivered whatever they guided, a strong order book. Those who have like of a Keynes have a 7,000 odd crore of order book to their PCB assembly unit only. Apart from that, the PCB manufacturing and the OSAT numbers to also flow in by 27, 28, and that is why everyone is discounting those as well in the valuation. And that is why that's the valuation is a quite a stretch over here. And I believe in the coming years, such kind of a story, the valuation to continue to be at a higher side.
Okay, all right. Praveen, but much of this EMS growth story is also driven by the global supply chain diversification away from China. So, do you see India capturing a meaningful share of that opportunity?
Uh, mm, See, if I compare with the China, we are far, far behind that. And to capture the growth from, China plus one strategy, definitely there are an opportunity and we are actually focusing on. Whether this is reached to a 10% of that, 15% of that, time will tell. But the kind of a capex the sector is doing, the kind of a diversification in terms of the segment or the technology partnership we are doing with large MNCs from the outside, there is a possibility in the next 5 years we will capture around 10 to 15% of the global EMS shift from the China to India.
Okay. All right, just one last question before we let you go, Praveen. We are stepping into the new Samvat. Which names do you see the leading the next leg of this rally and why?
Yes, so the next year, what I am seeing is those who are, doing a lot of a capex, diversification in the business, backward integration also. I'm liking those players. So the first name is the Amber. Amber going away from their RAC or the consumer durable segment towards the electronics. They had already announced three of the inorganic acquisitions this year. The JV, Korea Circuit JV also has been announced so far, where the major capex is lined up for them, PCB manufacturing, and that too in the multi-layer and the flex PCB. So there we are expecting that segment which contributes quite a low right now, which is around 20% of that. That's there we are expecting 35% of a growth story in the next 3, 4 years. And on the big, because they are the leader in the RAC and the RAC component manufacturing in this country, and we are also positive on the overall RAC demand for the next 3 to 5 years would be in the range of 15 to 17%. So they are the major beneficiary of that. So in our expectations that the company in the next 3 years, 25 to 28, grow at nearly around 27% in the CAGR in the EBITDA as well as PAT to be grow at a 50% CAGR. So and the return profile is also ROC is in the range of around 20%. So we believe it's a better placed valuation, also supporting comparing to the peer set. This trading at a 47 times FY28 earning right now. So 43 times FY28 earning. So I think this is a well placed right now. And next year, Amber to give a good return from here. Second name is Keynes because Keynes is the player in the PCBA segment, has done a lot in the diversification. So the industrial, auto, medical, these are the major segment. They are have a very strong order book, 7,000 odd crore of order book they have already in the PCBA. They are diversifying business towards the OSAT and the PCB manufacturing. Fourth quarter onwards, we will start seeing some numbers from the OSAT to come in. Already three clients are in the place for them, the large global clients, and already they have a good technology partners in the offset. So I think the 27 is a year where the offset is also bring some growth for them, and the PCB, which will also start by second half of 27, PCB manufacturing. There also we start seeing a number from the second half of FY27, and 28 is the majority. So there we are expecting around a 49% of EBITDA CAGR and the around 45% of a PAT CAGR story for them. So I think these two names are a preferred one for the next 1 year, where one can see a good return.
Okay, all right. Amber Enterprises and Keynes Technologies, all right. These are the two stocks that we need to watch out for. But with that thought, we have to let you go, Praveen. But thank you for helping us decode EMS sector and sharing your top picks also from the space. Wishing you once again a very happy Diwali.
Same to you. Happy Diwali.
The other segment we will be focusing on is the railway theme. After a blockbuster run in 2024, railway stocks have cooled off a little bit this Samvat and have given up a lot of their earlier gains. But analysts do believe that there are still some solid opportunities to be found with investors who are willing to take a medium to a long-term view. In his chat with Lavisha, Kranti Batini pointed out that BEML, Rail Vikas Nigam, and Titagarh Wagons look very attractive at these current valuations. These companies have very strong order books, a diversified business model, and are key players in the railway infrastructure and wagon manufacturing space. What's Bantini's advice? That investors should consider accumulating selectively and focus on companies that have a very strong execution capability, and most importantly, investors should remain patient. With steady capex-driven growth ahead, Samvat 2082 could very much mark a comeback year for this railway theme.
All right, in this edition of Fireworks and Fallout Themes, we put the spotlight on railway sector, the capex story that hasn't been sweet in Samvat 2081. We did see the stocks like RVNL, Texmeco Rail, IRCTC all slipped in Samvat 2081 as investors worried if it has been a pricey bet. But what could Samvat 2082 look like, and whether the bulging order book by the Railway Ministry, the heavy spending plans, and the most talk about Kavach plans could turn around the sector and the railway stocks back on track is something we will be understanding from our special guest of the show. Joining me is Kranti Batini, equity strategist at Wealth Mill Securities, to decode more about the sector. Kranti, wishing you the best of festivities this year and a very happy Diwali.
Thank you, Lavisha. Thank you for the season greetings. For you and the viewers at Moneycontrol, wish you the season greetings.
Kranti, let's start and talk about this sector in focus, because railway stocks did garner some traction in the past couple of months. But if you look at the Samvat's performance, all of them have witnessed correction. So explain us what has kept them out of investors' attention, and how does the way forward, Samvat 2082, look like?
Lavisha, yeah, the sector has been in a momentum zone in the past 12 months back. And from there onwards, the stock have witnessed some kind of a consolidation, making the higher tops. And there was some kind of a long corrections in majority of these railway stocks were concerned. Even though the stocks have run up ahead of their valuations, and the valuations look stretched for many of these stocks in the sector. So last 1 year, from the last Samvat to the current Samvat, the stocks have been in a consolidation phase. So that was the reason behind the stocks spending some kind of a time-wise correction. Their order books are in place at this point of time. This year, the execution capabilities also witnessed in a strong way. Around 56% of the budgeted capex have been spent during this year for the railway stocks are concerned. So wherever some kind of excesses have been built up for many of these railway stocks, in fact, these stocks have been a multi-baggers in the earlier years. So that was the key reason for these stocks to be in a consolidation phase in the past 12 months.
Okay, okay. Kranti, let's just focus, in between April and July 2025, we did see that the railways board spending has stood about at the highest among the large CPSEs and government agencies. Do you expect this capex push to translate into earnings? Because if you look at the last quarter, that has been fairly subdued across the board.
Yeah, we can see the same kind of capex spending to go ahead in the coming quarters also. Yeah, we had a long monsoon and a extended monsoon during this year. So normally in the first half of the year, some kind of a subdued capex spending we witness for any kind of a companies. So next 6 months are the crucial for these companies. Uh, so we can see some kind of a momentum to pick up. But one thing, Lovisha, here the key reason for the stocks consolidation and underperformance has been excesses that build up for these stocks. These stocks have been a multi-baggers starting from its bottom prices, and these stocks have witnessed some kind of a higher tops. So that's where the consolidations for many of these companies we witnessed. Now their valuations are attractive. The price momentum has taken a pause. So if any investor want to have a decent returns, one can start building up their portfolios with majority with railway stocks, but don't expect the same kind of multi-bagger returns. But they still can deliver some kind of a mid-teen kind of returns going ahead.
Mid-teens returns, all right. But yes, railways have always given a good narrative after the defense theme. But if you had to, suggest a fresh investors to enter at current levels, would you advise them, or would you say them to wait for some time?
By and large, if the investors have a longer term horizon, one can start accumulating these stocks. It should be very stock specific. In the previous bull run, what happened is, especially any company that's involved in railways, there was a price momentum, what we witnessed. In fact, many of the companies, they were in a bubble territory, okay? And from there onwards, we can see some kind of a moderation of the valuation. Now, after this healthy correction, we can see these stocks looks attractive at this point of time for a medium to longer term perspective.
Okay, okay. But between the two, if you look at PSU and private railway basket, which one would you prefer and why would that be?
One thing is, some stocks have been in a consolidation phase. Okay, how these companies are executing these orders, it can be both the PSU or it can be the private. Okay, it all depends upon their execution capabilities. For example, stocks like BEML, RVNL still looks attractive to me at this point of time. And from the private basket, Titagar looks very attractive to me at these valuations. So these are the top three picks where the investors with a medium to longer term, okay, they can pick up these stocks for a medium to longer term perspective.
Okay, okay. Kranti, Street has always been concerned between the disconnect of railway stocks, fundamentals and valuations. But what is your opinion on this? I mean, you did say that we are expected to grow in mid-teens, but from a valuations front, are railway stocks still at a pricey valuations?
That's an interesting question, Lavisha. But the recent correction from its peaks, the stocks looks attractive at this point of time. The railway theme is to stay for some more time. They have a clear-cut order book visibility, but where these companies are working, that's extremely crucial. One need to look at individual stocks at this point of time, which of the segments the company is working. So the wagon demand and also the modernization of railways and infrastructure spends are going to be there for next coming years. So that's where the demand for majority of these railway stocks are coming.
Okay. But let's also talk about two stocks which have grabbed the Kavach orders for enhanced safety and efficiency on key routes. That is your Concord Control, Kernex Microsystems. How do you see these counters riding the Kavach opportunity, and what lies ahead? Because both of these counters have surged stellar in the past 1 year.
Absolutely. Even stocks like Kernex Microsystems has locked in upper circuit today. Also, there were no sellers for the stock today. It was up by 10%. That's where investors need to be little bit cautious. Okay, that's where the valuation stretch come into these stocks whenever they enter into a momentum zone, and these stocks tend to be in spend in a time-wise correction also. But Kavach is going to be a long-term story going ahead. So the stocks which are involved in the Kavach theme is concerned, they are going to receive the strong order books, and earning visibility is clearly there. But whenever the valuations look stretched, that's where some kind of a profit booking also advisable for the investors in a medium to short term perspective.
Okay, all right. Just one last question before we let you, Kranti. Then, what are your picks from the railway space, and what is the reason behind that?
Yeah, my for this season for railways, BML looks very attractive to me. They look this PSU have a diversified business model. They are into railways. They are taking the advantage of the bullet train network that's going to come up, and also the defense space also giving the diversification for this stock. So BML looks very attractive to me, and RVNL, the strong player with respect to the railway infrastructure theme is concerned. And after the moderation of the stock prices in the recent past, looks very attractive to me. The railway infra theme is going to be the key role for RVNL. At this point of time, one can start adding RVNL for a time horizon of more than 1 year. And Titagar wagons looks very attractive to me at this point of time. The wagon theme is going to be there, both in terms of the passenger as well as the goods wagons are concerned. So these are the three stocks one can keep on their watch list and add at dips.
Okay, all right. Add on dips for all of these three railway counters. But with that thought, and of course, the discussion on the railway theme, we have to let you go, Kranti. But once again, wishing you a very happy
Thank
Diwali.
you.
Thank you so much for your time and joining us.
Thank you.
Now let's talk about one of the last year's biggest stories, which is the defense sector. Defense stocks were among the key stars of Samvat 2081, with the Nifty Defense Index gaining around 28% on strong investor interest. Experts believe that this momentum could continue going ahead into the new Samvat as well. The rally has been driven by geopolitical tensions, the government's push for self-reliance in the defense sector. India now manufactures about 65% of its defense equipment domestically and is moving towards becoming a global export hub. Recent policy moves, including the defense acquisition procedure, liberalized FDI norms, and a recent 9.5% hike in the defense budget, have cumulatively strengthened the sector's outlook. Prabhudas Niladhar is very bullish on HAL and Bharat Electronics, citing long-term value, strong order books, and strong alignment with the government's Make in India focus. Together with select private players, these companies are very well positioned to benefit from the next leg of India's defense modernization and export-led growth stories.
All right, so yes, we will be touching base upon the defense sector because that has been the flavor and fervor of the investor this Samvat as well. Now, the defense sector that used to once be the heavily import reliant is now emerging to be a global exporter of radar systems and missiles as well. If you look at number wise, if we deconstruct all of that, now the India's defense exports that have seen about 12% increase from FY24 and has grown almost 30-fold from the past decade itself. Now, the government's ambition is quite clear, that is to touch upon that $5 billion in annual exports by 2025 and $500 billion by 2029. So behind this rise is a steady policy push. If you look at the government's initiatives, that is your self-reliance initiatives, indigenization focus, defense corridors, they are all shaping up this ecosystem as well. And that is why you can see Nifty Defense that has surged about 26% so far this Samvat as well, and looks like a promising 2082 as well for Samvat. But yes, for investors, this transformation that is creating a new long-term opportunity, and that is why you can see majority of the defense counters, they have seen good momentum in this Samvat as well. If you look at HAL, if you look at Astra Microwave, majority of the counters have seen good gains so far this Samvat as well. But yes, to decode how Samvat 2081 has treated the defense sector and what lies ahead, we'll get shortly with our special guest of the show, who is tracking the length and breadth of this space. We have Amit Anwani, Vice President of Equity Research, Prabhudas Leeladhar, joining us to decode more about this defense sector and what lies ahead as well. Hi Amit, good afternoon. We are wishing you the best of festivities. But yes, Samvat 2081, that has been quite impressive for defense stocks, given that we had some geopolitical tensions from Ukraine to Middle East, and then we had our own Operation Sindoor in May. The pocket has seen quite a lot of interest, but how do you see the next Samvat to pan out? And why don't you reiterate the journey that we have seen for Samvat 2081 too?
Yeah, first of all, happy Diwali in advance to all the viewers. And as you rightly highlighted, structurally, we started our journey 7, 8 years back with defense acquisition policy, defense production policy in place. And of late, very recently, if you see at the start of the year, the government talked about the agenda for the full year that they want to fast track the projects. In December, they came out with the annual plan. And then we saw the technical procurement report, TCPR, which indicates at least 50% higher number of subsystems which government wants to procure over next, 5 to 6 years window. Then there was a policy in September which talked about the streamlining of the procurement manual for ease of procurement by all the stakeholders. On the top of it, if you see, there has been fast tracking. We talked about very recently the 97 LCA getting clearance. Then what I can read is also the 30,000 crore QRSAM project also got clearance. So if you see, talking specific again to 2025, there's at least 2,25,000 crores of AUN, approval of necessity, which are approved by ministry to be tendered out, are cleared. And this is across three services. So ballpark, if you ask me, the year gone by with respect to order intakes, order clearances was definitely noticeable. And as we have seen in past 3 years also, there's been very strong intake, but clearly all the commentaries and policy clearances very clearly indicate that the government is looking for next 2, 3 more years of reforms in the sector, which will bring in more orders as well for the companies.
Okay. Amit, let's also talk about, but in the past 1 year, we have seen that PSU defense stocks have outperformed the private ones. Do you see this momentum to continue, and what do you like the best, PSU or the private defense?
See, if you notice after Operation Sindoor and many other wars which are happening around, there's been one talk from the Indian Defense Ministry is the modernization of warfare, which requires a lot of defense electronics, as a change which can bring about, let's say, there's a talk about unmanned vehicles and drones and the way the warfare is going to change. But having said that, as you rightly said, the DPSUs are anyways running with a massive order book. So if we talk about 2,50,000 for HL, 75,000 for Bharat Electronics, MDL is also running 40,000 crore order book. And we are not stopping here. We're talking about a very strong order book. The HL is talking about 1 lakh crore more orders in pipeline. Bharat Electronics is talking about very lumpy QRSAM order, and then they can sustain 25,000 crore order. MDL is talking about the three additional submarine order and the large order worth 40-50,000, which is also looking for clearance in shipbuilding. So the prospects are still massive, and I feel the DPSUs can grow more than double digit anyways because of the current order book over next 5 to 7 years. What is changing for private sector is their involvement on technology side, their involvement on modern warfare, where defense electronics or radar based electronics or avionics will see a greater say in terms of value add in the platforms. So I think both the sectors coexist. The DPSUs have their role in terms of the platform development involved, getting more involved with the DRDO, and I think private sector can have faster growth. I would say, being more involved on the startup ecosystem as well as on the various advancements which are coming in terms of technology in the modern warfare. So I think private sector would have faster growth, but we cannot ignore DPSs for sure.
Okay, okay. But yes, Amit, let's also talk about that, all of these defense measures, they've been sitting on an order book which is 3 times of its current revenues. So how do you see the earnings growth in the coming quarters, and what can be the key challenges?
Right. So talking very specific, let's say for HL, the key challenge has been the engine deliveries, the 41404 engines. And we saw these 4 to 5 months, they have received 4 engines. This year, they're talking about at least 10 deliveries by the end of this year. So versus last year, the supply chain has definitely improved for them. Last year, they delivered 0 aircrafts. This year, they're talking about at least 8 to 10. So the major issue with respect to HL has been the engine supplies. Now talking about the growth, as you said, with 250,000 and the kind of order pipeline which we are seeing for HL, I am seeing lumpier FY28, FY29 numbers since these deliveries will also take a pace along with the helicopter projects. So I am expecting at least 15% plus CAGR in FY28, FY29 for HL. This year it could be between 8 to 10%, and then next year also could be maybe 8 to 10%. But I'm saying back end 12 to 15% growth in the later years since a lot of deliveries will come for HL. Coming to Bharat Electronics with the current book and order wins which they have seen, very clearly 16 to 17% growth is possible. For MDL, again, around 15-20% growth is possible basis the current order book. GRSC, not under my coverage, they're also talking about doubling of revenue in next 5-6 years, which indicates at least 13 to 14% growth, which can happen. So all in all, if you gather, there would be on an average for a blended basis, DPSUs can see 13 to 15% growth CAGR, and this is also matching with what the government wants. The government is talking about the procurement number to become, domestic procurement target of 3 lakh crores, which is roughly about 1 lakh 25,000 crores. That has grown at already at 13-14% CAGR in past 3 years. So definitely overall ecosystem will grow at least 13 to 15% for me over the next 5 years.
13 to 15%. That's a good earnings CAGR that we're expecting in the upcoming quarters. But yes, let's talk more about it. Last year we did see some funds which had stopped SIPs into these defense themes because of the bloated valuations. Do you believe that is now over? And how are you finding valuations at the current juncture?
See, valuation since we are seeing on F27. So talking about the defense electronics spec, which is trading at about 40 to 50x. The private sector companies are trading at 50x. The PSU like Bharat Electronics is trading at 42x on March 27. Talking about other OEMs and electronics like HL, which is trading at about 32, 33x on March 27. and the shipbuilders are also trading between 30 to 35. Now, if you compare this on March 27 numbers, definitely the valuations are expensive. There was a sharp correction we saw in past 12, 18 months, and now since after the rebound, the stocks has again gone up by 30 to 50%. So definitely I would suggest very selective bets wherever we get opportunity, like HL corrected to the levels of 3500 also last year. I think that is a very good price to enter. And also someone who has a longer view, I feel there's still a value. As I said, FY 28, 29, 30 will be lumpier years for especially DPSUs. So we have to be very selective in terms of where the value is and where the valuations correction is going to happen. But currently, definitely, as you rightly highlighted, the valuations on F27s are expensive, and there could be returns, but I think we should be very selective. So currently, HL is something where I see value, which is trading at about 33, 34x, and that is what we are also recommending to our clients.
Okay, okay. Amit, but how are you looking at drone stocks? Plenty of them did see a good rally during Operation Sindoor, but fundamental wise,
Yeah.
can we expect the momentum to continue?
So I think drone space, I think few companies already working, Zentech and Idea Forge. And if you see the large scale defense drone, India as a country has been taking it from Israel. We have Heron and few other which are also there. And as I said, there has been talk of modern warfare which is happening through drone. So a lot of PSU companies, notably HL, is also talking about unmanned combat aerial vehicle, which is kind of larger unmanned vehicle. And I think per se for defense, we are talking about the massive capability building which is going to happen in drone. And in fact, if I recollect rightly, there were few policies also to promote localizations of drones, particularly to defense. So for other areas, obviously, things are picking up fast for commercial agri side. But for defense side, because of technology, I think there's a lot of investment happening there. And it's definitely a very encouraging area. But I think the meaningful traction for defense companies in drone is yet to ramp up. And as I said, notably for me, HL is working on few platforms, and Zentech has also worked on few platforms. But if you see, even for Zentech, the simulations and other training platforms are delivering higher value. So definitely, this is an area where very strong with a very strong potential, and few companies who are working can come up with more products here. But currently, I think for next 1 2 years, I am not seeing major contributions happening here. So this is a watchful space, I would say.
Okay, okay. Watchful space. Let's from drone. Let's talk about shipping stocks also, because recently we did see that the government has approved about 65,000 crore rupees for the sector. So how are you placed on this theme, and what is your outlook going forward?
Right. So I think the 65,000 rupees, if I'm correct, we are going to focus on commercial ships as well, and the maintenance and service of commercial ships as well, particularly to the shipbuilding side for defense. I I see very small things, which are overlapping with the current 65,000 policy. I believe that is more for the commercial side. But having said that, in pockets and with full strength, government has worked towards the shipbuilding sector, and we saw the pipeline as I talked about earlier. We're talking about three submarine order, which should be as high as 27,000 to 30,000, which might go to Mazga dock. The second indigenous aircraft carrier is under making by Cochin Shipyard, and also these companies are focusing on the increased share of the repair and maintenance of shipbuilding, which is a very critical and focused area by the government as well. And that somehow gives the sustained revenue and margins to the defense shipbuilding company. We talked about the large 50,000 crore order where L&T was a bidder along with a partner, and MDL was a bidder. So now these are all large scale orders where uh, I think the total would be more than 1 lakh crore anyways for next 1 year. So the pipeline anyways is very robust. All these companies, as I said, MDL is with 40,000 order book, currently going very strong. And the other three companies, including GRSC, Cochin, also targeting very healthy growth. So I think despite these policy focusing on OM and O&M, which can be beneficiary to companies who want to get into commercial. So I think GRSC talked about getting into commercial shipbuilding for maintenance. And Cochin Shipyard has a, I think, more than 20% contribution coming in from the commercial or defense ship O&M. So I think O&M, operations and maintenance or retrofit for shipbuilding could be a big area where these companies can benefit from the current policy. But having said that, the shipbuilding defense policy is already robust and there many orders will be cleared out in next 2 3 years for shipbuilders.
Okay, okay. Amit, let's talk about the second quarter because brokerages they are expecting that the revenues look strong for majority of the defense counters, but margins could be under pressure. Help us decode that why margins could be under pressure for majority of these defense counters.
See, I think if you see defense, typically 4Q becomes very lumpier with almost 40% of their revenue coming in 4Q. Q1 starts with 15% of execution. Q2 is typically 20-25% of execution, which is getting accounted. So we have to see defense as a cumulative way in terms of numbers also. There could be some quarterly variation. But talking specific to this quarter, I think if you see Q1 also in few commentaries, including Bharat Electronics, they talked about because of supply chain, subsystem, and component level, and to some extent, whatever critical material, there was 200-300 crore sales miss. For HL, it was engine. So broadly, if you see all this platform manufacturers, there's in proportion somewhat supply chain dependent, and that has been be the reason for non-performance despite very strong book. But having said that, I think they managed Q1 very well, where the numbers came very strong and healthy. For me, the companies under my coverage, I'm expecting a healthy number, except some margin normalization, which is happening also because of the some mix of commodity plus the supply chain. But I think that is not a major area of worry for me because, as I said, considering the traction which has happened and we are hearing for each companies, including the DPSUs and the private sector, I think they'll be able to manage to have very strong or healthy H2 this year as well.
Okay, okay, all right. Amit, I know you discussed about HAL as well, but any other
Yeah.
topics which you're eyeing from the defense back?
See, my coverage includes HL and Bharat Electronics, of which HL I think I highlighted. But if you see overall defense spec, despite taking my passive coverage, I think the few interesting companies which again will be beneficiary in the long term. Astra Microwave is one company which I personally feel that could be beneficiary in the defense electronics space. Data patterns, however, valuation looks expensive, but again, they have been growing very strong and they have the potential if investors wants to have it with a 2 to 3 year perspective. I think these are two companies in private defense space. I think there's one company, not directly the so-called defense, but solar industries is very promising. They have market share, a very strong market share in defense. This company has been growing. Very recently, they entered into some other arenas in defense, and they seems to be on a strong footing. So there's a few passive stocks, passive coverage under my umbrella, and I like this companies personally.
Okay, all right. All right. With that, Amit, we have to let you go. But thank you for joining us and explaining us defense sector, so well. And hopefully in summer 2082, there is more upswing left in the defense theme as well. But with that, wishing you a very happy Diwali and the best of festivities.
Happy Diwali and thank you so much for having me. Thank you.